Certainly lots to talk about, and the inputs into the decisions of where we allocate our capital continue to flow in. I'm not even sure where to start, but there's COVID news, there's certainly stimulus news, and there is the earnings season going on, wherever you want to start.
Well, I think we ought to talk about earnings, because I'm kind of happy that we're starting to get back to fundamentals and not talk every day about vaccines and every day about what's going on in the election. But earnings season so far is going very well. 91% of the companies that have reported so far in the S&P 500 have beaten estimates versus a 75% average. The surprises are 21% ahead of expectations relative to an 11% normal beat rate. So clearly corporations have adjusted to the slowdown, adjusted to the pandemic, and have built up a tremendous cash reserve that ultimately may be deployed in terms of dividends and stock buybacks.
Yeah, that would be good. One of the things that you look at when you listen to these earnings reports, and you spend a lot of time, and your team does listening and reading these reports, is what does it compare to? And I think that's an important distinction.
Yeah, I mean, the comparisons obviously are very easy. Next quarter, our economy shut down around March 15th. Well, that's going to be a very easy comparison versus an economy that's at least partially reopened and in some cases fully reopened. So that's going to make an easy comparison. And historically, the stock market tends to like it when year-over-year comparisons go from negative to positive and are accelerating.
And the second thing that you look at is not only the report card of what they did, but more importantly, where they're going.
Yeah, and the guidance has been universally positive so far. I mean, we saw the bank numbers. The bank numbers were good, but the stocks had just run ahead of the fundamentals. But, more buybacks. They reduce their reserves because they don't feel the economy is in the kind of jeopardy they thought it was a few quarters ago. So bottom line, the earnings situation remains bright and rates still remain very low.
And that's the reason why when we talk about the economy perhaps struggling, Main Street versus Wall Street, that's really what it is. These are very large companies, S&P 500 being Standard & Poor's largest 500 companies who can make money, throughout. For example, if you look at the restaurants that are in the S&P 500, that is not Joe's Bar and Grill on the corner.
No, and even beyond that, restaurants in the S&P 500 really are not that big an allocation, right? I mean, it's mostly about technology, healthcare, large consumer cyclical companies like an Amazon, Home Depot, and the rest, all of whom actually remained open throughout the pandemic.
That's exactly right. So earnings look good and are important, and that's the reason why we're starting to rally. A question we're hearing a lot, though, is it feel like it's a bubble is forming, and there's ways to look at that, to kind of dissect that term a little bit.
You always like to say I had the misfortune of running a tech fund in the year 2000 when the tech bubble burst, and I am seeing some similarities between 2000 and now. We're seeing a lot of IPOs. We're seeing the rise of the SPACs, special purpose acquisition corps, which is essentially another way for a company to go public. So the deal market and the IPO market are very hot. Forward valuations are getting pretty high. 22, 23 times forward earnings is about 40% above normal. But again, you have to balance that off with extremely low interest rates. And frankly, there is no alternative continues to gain credence, particularly when you have a 10-year yield at about 1.1%.
And so low interest rates are going to be here. Earnings are here. And money is moving back and forth from sector to sector. And for example, we talked a lot about on the show and with our clients about sectors that could do better with the new administration. Energy and financials were some that we highlighted. They are getting a lot of the flow right now.
They are, and we also talked about giving experiences a second chance. Take a look at the airline industry. Maybe pick one or two that stand out as really well-run enterprises. Look at the cruise lines. Look at hotels. Look at restaurants. Look at things like leisure and hospitality, auto rental companies, transport companies. That's where I think the opportunities are, not as much with the former leaders, but with the emerging leaders from the value space.
And so we have those sectors, we have some international space, and of course, interest rates going up means that you have to pay attention to your fixed income as well.